Okay, let's unpack this. Picture this image. One man, just one guy, really, maybe a few key investments, but using his voice, his pressure, to push the world's most valuable company around.
Yeah, Apple.
Exactly. Not just, buying stock in the market, but actively trying to change the market itself.
And that image, it really isn't an exaggeration when you talk about Carl Icahn. It's sort of his whole deal, isn't it? His name carries, well, a lot of weight, both respect and maybe a bit of fear in the financial world.
Definitely fear.
Because he's not your typical buy and hold investor. He doesn't just park his money and hope. He buys shares specifically to get a seat at the table, or at least a loud voice outside the room.
Right, to push companies, sometimes really hard.
Exactly, to fundamentally change how they operate.
All right.
Their leadership, their strategy, and famously how they use their cash, especially those huge cash reserves.
And that Apple situation, the pressure for that massive $100 billion share buyback, that's just a perfect example, isn't it? It wasn't just about the money. It felt like a real power move. High-stakes stuff.
Totally. It really stretched the idea of what an activist shareholder could actually pull off, even without, owning half the company.
So that's our mission for this deep dive, right? We've got the source material, articles, notes, digging into his career, and we want to really get inside this guy's head, understand this unique figure.
Yeah. How does he spot these things others miss? What's the actual mechanism behind his, let's face it, often confrontational style?
We're going to look closely at that investment mindset, almost cold, detached logic. We'll explore how he went up against giants like Apple, McDonald's.
And that legendary Herbalife battle?
Wow, yeah, the Herbalife fight. We need to get into that. Basically, figure out what makes him so feared in boardrooms, but also kind of admired by certain investors.
And pull out the key lessons, right? What can we actually learn from how he operates?
Because honestly, if you've ever owned stock, even a few shares, or just watched these huge corporations and wondered, how could one person possibly shake things up? How could they influence $1 trillion company? Icahnn's story, well, gives you some real answers.
It really can shift how you see investing, how you see corporate power. It's fascinating stuff.
Okay, let's dive in.
Absolutely. And it's not just finance, is it? His story is kind of a lesson in leverage, in how to apply pressure strategically and just having that rock-solid conviction to challenge the way things are usually done, even in these massive, complex systems.
So, to really get Icahn, we need to start with that foundation, his core philosophy. The sources really hammer this point investing with cold logic, like zero emotion involved.
Right. And it starts with his view of the market itself. He fundamentally rejects the idea that it's, fair or efficient or rational.
He doesn't buy into the efficient market hypothesis at all.
Not even close. The sources say he sees it as deeply flawed, often totally irrational, driven by waves of emotion, fear and greed cycling back and forth.
Politics too, right? Media hype.
Exactly. Political wins, media narratives, and maybe the biggest one, just plain old herd behavior. People following the crowd instead of thinking for themselves. Logic, he thinks, often takes a back seat.
Okay, so if the market's messy and emotional, that's where he sees the opening.
That's precisely it. That chaos, that inefficiency, is where he finds his target.
Oh.
The mispriced company.
But how does he spot them consistently? I mean, aren't thousands of analysts looking at the same stuff?
Well, that's the thing. He's not chasing the latest trend or buying into the CEO's rosy predictions. It's about digging deeper than the surface noise. He's looking for situations where the market's emotional reaction, or maybe its failure to understand a complicated structure or a management issue, has created this big gap.
A gap between the stock price and what the company's really worth.
Exactly. Based on its tangible assets, its real cash flow, stuff that's undervalued or just being badly managed. It's less about guessing future growth and more about finding current value that's hidden or ignored.
Which leads right into that quote the sources highlight. I don't invest with emotion. I invest where the numbers are wrong, and I make them right. That last part is key, isn't it? I make them right.
That's the activist heart of it. It's not passive. He's not just betting the market will eventually figure it out.
He forces the issue.
Right. He uses his position as a shareholder, sometimes a huge one, sometimes just loud and strategic, to force the company to do things he thinks will unlock that value. Fix the mispricing.
Yeah, what kind of things?
Oh, pushing them to sell off a division that's dragging them down, maybe change the CEO, shake up the board, change how they use their capital, demanding Big stock buybacks or special dividends to get cash back to the owners, the shareholders. It's about imposing his analysis onto the company to get the value out.
And that's totally different from how most traditional investors operate, right? They might buy based on a story or faith in the management.
Yeah, completely different. The source uses the term surgical coldness, which I think really captures it.
That's good. Surgical coldness.
He's not impressed by the fancy mission statements or the glossy reports. He and his team, they're digging into the raw numbers, line by line through the financials. Looking at the corporate governance, are there weak spots? Conflicts of interest.
Identifying where management might be, slacking off or just complacent.
Exactly. Looking for those structural cracks where value is just leaking out or being hidden because of bad decisions or because management isn't really aligned with the shareholders. It's less about industry hype and more about balance sheets, cash flow, and whether the bosses are really working for the owners.
So he's not chasing the hot tech stock everyone else is buying.
No, he's often looking at companies the crowd is ignoring or maybe misunderstands. And then he steps in and challenges that consensus head on.
And he's willing to put serious money behind that challenge, even if everyone thinks he's nuts.
Billions, sometimes.
Yeah.
Based purely on his conviction that the numbers are wrong and he can fix them.
Yeah.
And that's a real mindset shift for anyone listening, isn't it? It pushes you to look past the surface story of any company, maybe any organization.
Ask different questions.
Yeah. What do the objective numbers really say? Is the leadership truly doing the best job for stakeholders? Where are the hidden inefficiencies? Where's the untapped potential being ignored? If you adopt that kind of detached analytical view, focusing on fundamentals over feelings, well, it could change how you evaluate things, right? In finance, sure, but maybe elsewhere too.
It definitely challenges that default assumption that the market knows best, or that management always has the right answers. And that whole approach, analytical, detached, but ready to apply pressure, we saw it play out big time with Apple.
Ah, yes, the Apple campaign. This is like the textbook case study. Icahn turning pressure into real power. Okay, so cast your mind back to 2013. Apple was, well, Apple. A giant.
Huge. Not just valuable, but like a cultural icon. Looked like total success from the outside.
Right. But Icahn, even with that massive valuation, saw something fundamentally off. He thought it was undervalued.
Which sounds crazy, right? How could Apple be undervalued then?
It seemed counterintuitive. But his logic, laid out in the sources and what he said publicly, it came back to that cold analysis. Apple was sitting on this absolutely enormous pile of cash, over $140 billion in reserves.
And for Icahn, that wasn't a good thing.
Nope. Not a sign of strength, but a sign of inefficiency. A lazy balance sheet, as he put it.
I love that quote where he jokes, if Apple were a country, it would be one of the richest and one of the most inefficient.
It sums it up perfectly. He just believed holding that much unproductive cash, especially for Apple, which wasn't exactly facing bankruptcy, was actually bad for shareholders. That cash could be doing more for the owners than just earning tiny interest.
So, true to form, he didn't just buy some stock and wait quietly.
No way. He launched this massive public campaign, which was incredibly bold, you have to remember, taking on Apple. The scale, the brand loyalty. It took guts.
So what did he actually do, the sources mention?
Well, he started buying up a big stake, yeah. Ended up being worth billions. But the real weapon wasn't just the share count. It was going public. Using his reputation, his media savvy.
Tweeting at Tim Cook directly.
Yep, tweeting directly at the CEO. Publishing these open letters that got picked up everywhere by the financial news. Giving interviews, hammering his point home. It wasn't your usual quiet chat with investor relations. It was a PR assault aimed squarely at the C-suite and the board.
And the demand was super specific. Use the cash. Buy back stock, give value back to shareholders. He even put that $100 billion number out there.
Yeah, $100 billion, which back then was just an almost unbelievable amount for a buyback. It forced everyone, Apple, the board, the whole market, to ask, wait, why are they sitting on all that cash? What's the plan? Icahn basically put them on the defensive and got other shareholders thinking maybe he has a point.
And the amazing part is, it actually worked.
It really did. Now, okay, Apple didn't turn around the next day and say, sure, Carl, here's $100 billion. But they absolutely felt the heat and responded.
They boosted their buyback program significantly.
Massively. They accelerated, expanded it. Over the next few years, Apple returned hundreds of billions to shareholders through buybacks and dividends. Way more than Icahn's initial demand, actually. But his campaign was clearly the spark, the catalyst for that huge shift in their thinking about capital allocation.
And Icahn himself, he did all right out of it.
Oh, yeah. Made over $2 billion profit on his Apple shares before he sold out in 2016, saying he felt The stock was fairly valued by then.
But the source's stress, it wasn't just about his profit.
Not at all. That was the bigger picture. It was this incredible demonstration of activist power at the absolute highest level. Here's one investor, remember, without a board seat for most of this.
Right, no formal control.
Managing to significantly change the financial strategy of the biggest tech company on the planet. It proved his power wasn't just about owning shares. It was about the strength of his argument, how he used public pressure, and his sheer willingness to take on the establishment. It sent a message.
Yeah.
Even giants have to listen to their owners, especially when Icahn starts making noise.
It's a pretty stunning lesson in leverage. What does that tell you, listening right now, about shareholder advocacy, even if you only own a few shares? And how does it make you think about companies sitting on huge cash piles? Makes you wonder about those missed opportunities, right?
Absolutely. It shifts the perspective from just being a passive owner to thinking about active engagement, but demanding that companies use capital effectively.
Okay, speaking of demands and battles, maybe none were as nasty, as public, or as personal as Herbalife.
Oh boy, Herbalife, yeah, that was something else. A multi-year war, really, that had Wall Street and the media completely gripped. It kicked off late 2012. Bill Ackman, the hedge fund guy from Pershing Square,
Right.
he makes this huge public splash, announces he shorted Herbalife stock to the tune of $1 billion, then gives this massive presentation calling the company a pyramid scheme, totally fraudulent, predicts the stock's going to zero, regulators will shut it down.
And the market reacted instantly. Shares plummeted. Huge controversy overnight.
Total chaos. But while everyone else is panicking based on Ackman's claims, Carl Icahn looks at the same situation and sees, well, not a pyramid scheme about to collapse.
He saw an opportunity.
Exactly. An opportunity created by what he thought was a massive overreaction, maybe driven by Ackman's very public, very aggressive campaign. He thought Ackman and the market following him were just plain wrong.
And he wasn't shy about saying so. That incredibly heated argument they had live on CNBC in early 2013.
Oh, legendary. It was raw. Icahn basically said flat out, I don't like Ackman. And I think he's dead wrong about Herbalife.
That wasn't just investment talk, that was personal.
It felt like a declaration of war. And sure enough, within weeks, Icahn starts buying Herbalife stock. And not quietly either. He did it loudly, publicly, defiantly, basically planting his flag directly opposite Ackman's short position.
So you had Ackman betting huge that the stock goes down, Icahn betting huge that it goes up, a massive public showdown.
A classic long versus short battle between two billionaire egos with totally different views of the company. And Icahns' play was much more than just buying shares.
He got really involved, didn't he?
Deeply involved. He built up a massive stake, eventually owning over 17%, making him the biggest shareholder. And with that stake came real power. He took several seats on the Herbalife board.
So he was inside shaping strategy.
Exactly. Defending the company publicly, pushing back against Ackman's narrative, and crucially, standing firm. For years, through all the negative press, the regulatory investigations that Ackman was pushing for, Icahn just held his ground.
While Ackman kept hammering away.
Relentlessly. Doubling down on his short bet, giving more presentations, running PR campaigns against Herbalife, lobbying Washington hard to get regulators like the FTC involved. He was all in on trying to bring the company down.
But in the end, the sources are clear. Herbalife didn't collapse.
It survived. The regulatory probes didn't shut them down as Ackman predicted. And after 5 long, brutal years, Ackman finally threw in the towel in early 2018, closed out his short position.
At a massive loss.
Yeah, reports say Pershing Square lost over $1 billion on that trade. Meanwhile, Carl Icahn, who'd held firm, supported the company, gradually sold his shares over the years.
And made a huge profit.
Well over $1 billion in profit, according to reports.
Wow, so it wasn't just a financial victory for Icahn, it was like public humiliation for Ackman. The sources call it a masterclass in contrarian conviction.
That sums it up perfectly. He bet against the fear, the panic, the noise, this incredibly aggressive short attack. He trusted his own homework, saw value where others saw fraud, and just had the steel nerve to stick with it for years. It showed the power of deep conviction against the market consensus. What does that whole saga tell you about investment psychology? The risks and rewards of taking such a public contrarian stance when everyone's screaming the opposite.
It definitely shows that being loud doesn't make you right. Okay, let's shift from that intense battle to another giant he tangled with, McDonald's. A very different company, right? Global icon, steady earner.
Absolutely. And that stability, that massive cash flow, that's exactly the kind of thing that would attract Icahn's attention. Huge machine generating cash. But typical Icahn style, he looked under the hood.
And saw things he didn't like. Inefficiency, complacency.
That's what he argued. Perceived inefficiencies. Maybe a board that was a bit too comfortable, management not quite pushing hard enough for shareholders.
But his stake there was pretty small, right? The sources say less than 1%. How did he make waves with that little?
Yeah, this is really interesting about his strategy. He wasn't trying to take over McDonald's or run the restaurants. The sources say his goal was much sharper, fixing its boardroom, making sure management was truly focused on shareholder value, not just cruising along.
He has that quote, shareholders aren't just passengers, they should be the ones steering the ship.
That's his philosophy in a nutshell. It challenges that old model where management runs the show and shareholders just collect dividends, right?
Totally. He sees shareholders as the owners who should be actively involved, especially if they think things aren't being run optimally.
Particularly around governance or how capital is being used.
So what exactly did he want McDonald's to change?
The source material points to a few key areas he often focuses on. One was capital return. He pushed them to give more cash back to shareholders, specifically pushing for higher dividends.
Okay.
Another was the board itself. He wanted changes to who was on the board, arguing for more independent directors who'd really challenge management on behalf of the owners.
And governance.
Yeah, addressing what he saw as governance weaknesses, maybe modernizing some of their corporate responsibility stuff too, though the details on that last part are a bit fuzzier in the sources we have.
And again, he didn't do this quietly behind closed doors. He used his signature weapon.
The public letter. Media appearances, stirring up public debate about his demands, forcing McDonald's leadership to respond publicly, not just internally. He brought the whole discussion out into the open.
And even with less than 1%, the sources say his influence reverberated. They couldn't just ignore him.
Right, because it's Carl Icahn. His reputation alone brings attention. When he targets a company publicly, the media jumps on it. Other shareholders start paying attention to his arguments. It creates this spotlight effect. Huge pressure, even from a small stake.
And McDonald's did make changes.
They did. They tweaked their dividend policy, bumped up the payout, they shuffled the board, brought in some new independent directors, and they talked about tightening up executive oversight.
So the big takeaway from McDonald's is pretty powerful. It's not just about how many shares you own. Strategy matters more.
Exactly. It shows active shareholding isn't just about having control. It's about conviction, doing the analysis, and having a smart strategy to push for change, no matter your stake size. So for you listening, if even tiny shareholders can have an impact, what does that mean for your potential role? Maybe makes you think differently about shareholder votes or engaging with companies you invest in?
Yeah, it definitely shifts the perspective from being passive to potentially being an advocate. Which brings us right back to that tool you mentioned, public pressure. The open letters, the media game.
This is such a core part of the Icahn playbook. Leverage in finance usually means debt. For Icahn, leverage often just means attention, getting eyeballs on the situation.
And the open letter is his main tool for that. It's so different from how most investors operate. Quiet emails, maybe a phone call.
Totally. Icahn weaponizes communication. He doesn't just send a letter to the board, he publishes it, puts it out there for the whole market, the press, every other shareholder to see. That quote sums it up. Transparency is pressure. If they won't listen in the boardroom, they'll listen when the public is watching.
He knows boards hate bad press, hate public criticism. By going public, he bypasses the closed doors and forces them to deal with it out in the open, mobilizes pressure from outside.
And these letters, they aren't just angry rants. The sources make that clear. They're strategic weapons, carefully written, packed with financial analysis, laying out a logical case for why change is needed, designed to persuade other shareholders, build momentum, and apply maximum heat, often very direct, very critical of specific people or decisions.
The sources mention other examples too, like eBay back in 2014.
Oh yeah, classic Icahn campaign. Bought a stake, then unleashed a series of public letters demanding eBay spin-off PayPal.
He thought they were worth more apart.
Exactly. And he publicly attacked the reasons for keeping them together, called out board conflicts, questioned management's motives, just dismantled their strategy right there in public view.
And it worked.
It did. eBay resisted at first, but the public pressure from Icahn, plus other shareholders he rallied, was intense. Eventually, they agreed, spun off PayPal in 2015, and guess what? Both stocks took off afterwards, billions in value unlocked, just like Icahn predicted his public pressure campaign would do.
He tried something similar with Netflix too, right?
Yeah, took a big position, then started publicly talking about how Netflix should explore selling itself. Argued it was undervalued, a great takeover target.
Did they sell?
No, a sale didn't happen then. But just him putting the idea out there publicly with his stake and reputation, it created a ton of buzz, definitely influenced the stock price, and forced strategic conversations to happen. Showed how just floating an idea publicly could have real impact.
And Apple, we already talked about how the $100 billion buyback demand was seeded through those public letters and interviews. Maximum pressure.
The key reason this all works, as the sources point out, is he controls the narrative. By going public, he's not just talking to the board. He's talking through the media to everyone else, other shareholders, potential investors, the public.
He's basically recruiting allies.
Exactly. Shareholders who agree, reporters looking for a story, a market that often likes the idea of shaking things up to unlock value. He orchestrates this collective pressure by shifting the public conversation.
So the ultimate leverage isn't just money, it's controlling the story.
That's what the source suggests. Control the conversation, and you can control the outcome. And think about that principle outside finance. Where else does public pressure shape things? Politics, social issues, maybe even your own workplace. That idea, transparency, and public discourse as tools for change, it applies pretty broadly.
It really makes you think about how influencing perception can be as powerful as having formal authority. And this whole philosophy, these tactics, they're all kind of wrapped up in his company, Icahn Enterprises, right?
Yeah, Icahn Enterprises, ticker IEP, is basically the mothership for his whole operation.
Yeah.
It's publicly traded, and it's the embodiment of his strategy. Its holdings are super diverse: energy, cars, pharma, real estate, you name it.
Reflects his contrarian bets across different industries.
Totally. And these aren't just random picks. They're usually companies where he sees that classic Icahn opportunity. Undervaluation, operational problems, governance issues he thinks he can fix.
In IEP itself, it's not just passively holding these assets.
No, definitely not. The sources say IEP's whole philosophy is about creating value by tackling inefficiency head-on. It actively intervenes in the companies it owns, pushing for strategic changes, operational fixes, financial restructuring. The investments are the activism. IEP reshapes its portfolio companies.
And the market even treats IEP's stock differently because of this, right?
It does. IEP's price often jumps or drops based on Icahn's latest moves news about a new target, a new open letter, how a boardroom fight is going. It's not just about the underlying earnings of the companies IEP owns.
It shows that influence itself is a form of capital in the market.
Exactly. And few wield that kind of influence capital like Icahn.
His personal net worth, often used as the scorecard, was around $8.8 billion as of 2025, according to Forbes.
Which is, staggering. A clear measure of his financial success over decades. But the sources argue his real legacy, his biggest impact, goes beyond the dollars.
It's measured in
the companies he changed, the fear he put into complacent CEOs across the country, and maybe, most importantly, the blueprint he created for a different kind of capitalism.
A kind where shareholders don't just wait around.
Right, a more demanding, more confrontational model, where shareholders don't just trust management or hope the market fixes things. They use their ownership rights, their influence, to actively force improvements, to unlock value they see trapped inside the company.
The source wraps this up by saying his name basically is shareholder activism now, but it's all built on that core belief. One voice, used smartly, used loudly, can actually change the path of these massive corporations.
He didn't just get rich. He changed the game between shareholders and managers, showed that change can be forced, one company, one public fight at a time. So when you think about this new kind of capitalism, how does it sit with you compared to the traditional view? What are the potential upsides? Percents more accountability? Maybe. And downsides, maybe too much short-term focus. It's definitely something the market still debates.
For sure. It raises big questions about power and incentives inside companies. Okay, so we've looked at his philosophy, the big fights, the tactics. Let's try to boil this down. The source material gives us 5 key lessons from his playbook, his $8.8 billion playbook.
Yeah, these are like the core principles distilled from that long, legendary career. Useful insights, maybe not just for investing.
Okay, lesson 1. The market is not always right look for what it's missing.
Absolutely central. He made his fortune finding those mispriced assets the crowd ignored. Didn't wait for everyone else to agree. He jumped in before they did. Really challenges that idea of market efficiency, doesn't it? Makes you question the consensus.
Lesson 2. You don't need majority ownership to create massive influence.
We saw this with Apple, McDonald, so many others. Reshaping global companies with relatively small stakes. Power for him is about pressure, position, using that public voice strategically. not just controlling votes.
Lesson 3. Emotion is expensive. Invest with logic and cold precision.
That's his operating system. Decisions driven by data, by analysis of the numbers, the governance flaws, the potential value unlock. Not hype, not fear, not liking or disliking a company personally.
Except maybe Ackman.
Well, okay, maybe some exceptions, but generally, discipline over drama. The Herbalife fight really tested that principle, sticking with it through all that heat. Success built on analysis, not sentiment.
Lesson 4. Speak publicly when private negotiations fail.
The open letters aren't a last resort. They're often a first strategic strike if quiet talks aren't working. Make the issue public, rally support, apply pressure. Transparency as a weapon. Think eBay and the PayPal spinoff.
And lesson 5. Don't wait for value, unlock it.
This is maybe the most defining one. Most investors hope things get better. Icahn doesn't hope. He acts. He sees trapped value due to bad management, bad structure, whatever, and he intervenes to force it out. He creates the outcome, makes the numbers right himself.
Yeah.
So thinking about how you might apply these, even if you're not taking on Apple, it's about developing that critical eye, right? Questioning the common narrative, recognizing you can have influence even without formal power by being strategic, communicating well, finding allies, and crucially shifting from just noticing problems to actually taking informed steps to fix them, rather than just hoping someone else will.
It's about going from being a spectator to maybe being an active player in whatever game you're in.
Well put.
So, Carl Icahn's career, as laid out in the source material we covered, it really shows that one voice, if it's backed by solid analysis, real conviction, and a smart strategy, it can genuinely shake things up, even with the biggest companies out there.
And it leaves us with that great question from the source. When you own something, stock, a role, whatever, are you just holding it passively? Or are you recognizing you might actually be holding power?
Yeah, taking that beyond investing, what does his story tell us about the power of acting strategically, challenging things in any system we're part of? Definitely something to think about.
It really is.
Well, thank you for joining us on this deep dive into the source material on the truly legendary Carl Icahn.
It's been fascinating digging into someone who basically built a career spotting waste and having the sheer will to demand it get fixed. Hopefully these lessons give you something to think about how you might find and unlock value wherever you happen to see it.